Yes, students. Now we will discuss the questions on marginal costing from ICI material. We'll start with multiple choice questions. Under marginal costing, the cost of product includes prime cost only, prime cost and variable overheads, prime cost and fixed overheads, prime cost and factory overheads. Which is the answer, guys? Prime cost and variable overhead. And please be careful to be very clear. It is prime cost and variable manufacturing overhead. Okay, because they have told cost of the product. They didn't ask only variable cost. Clear? So, which are the costs which are included in the cost of the product under marginal costing is the prime cost, that is direct material, direct labor and other direct expenses, plus variable manufacturing overhead. Sir, if it is a variable administrative overhead or variable selling overhead, it is variable in nature. But will it be included in the cost of the product? No, guys. But out of the given option, we are choosing B, guys. Second one, reporting under marginal costing is accomplished by treating all cost as period cost? No. Eliminating the work in progress inventory account? No. Matching variable cost against revenue and treating fixed cost as period cost? Yes. Matching variable cost against revenue means not in amount, guys. We are just reducing it to derive what? Contribution. From contribution, we reduce fixed cost. So the answer is C. Let me read D also, including only variable cost in income statement. No, no. See, we will make decisions based only on variable cost and contribution. But in income statement, do we include fixed cost also? Yes, at the end, we also show the profit. Period cost or variable cost, fixed cost, prime cost, overhead cost. Which is that, guys? Fixed cost. When sales and production in units are same, then the profit under marginal costing is higher than that of absorption costing. Marginal costing is lower than that of absorption costing. Marginal costing is equal to that of absorption costing. None of the above. What is the answer, guys? Equal. Equal. I had explained this in my class when I was solving the question, guys. So please be careful. I will just explain here. Listen. Sir, when there is no opening stock and closing stock, when there is no opening stock and closing stock under absorption costing as well as marginal costing, that means the profit would be same. So yes, profit would be same, guys. See, there will be difference in one item, that is the fixed manufacturing overhead. The fixed manufacturing overhead, if you ask me, will it affect the cost of production? Yes, it will affect. But whatever is the under absorption or over absorption, you will come and later adjust it. So automatically profit will be taken care. So because of fixed manufacturing overhead, will my profit get impacted? No. Same way here, fixed manufacturing overhead, whatever is the actual, we will take care later. Whatever is the amount. That means this item under marginal and absorption will affect my cost of production or product cost, but it will not affect my the profit. But when it comes to valuation of inventory, guys, I will value the inventory under marginal costing only at variable cost. Whereas under absorption costing, I will value it at variable plus fixed manufacturing cost. Because of this, my stocks would be overvalued under what? Under absorption cost. Due to this, will it have an impact on profit? Yes, it will have an impact on profit, guys. It will have an impact on profit. Clear? Yes. So when there is no opening stock and closing stock, that means profit should be same under both. Yes, sir. Let us go back. Next, when sales exceeds production in units, then profit under. Guys, when sale exceeds production, what do you understand? There was an opening stock. There was a opening stock. Correct? Yes, sir. Don't worry about closing stock now. Clear? So that means there was an opening stock. So opening stock, we will add it to the cost or deduct it from the cost. Add it to the cost. Now, you tell me, opening stock will be overvalued in absorption costing or undervalued? Overvalued. So when opening stock is overvalued in absorption costing, this is absorption only, no? Yes. It is overvalued in absorption costing means, sir, my cost would have gone up. Correct? Even my total cost would have gone up. When my total cost has gone up, profit will go up or come down? Come down. So when compared to marginal costing, my profit in absorption costing is lowest because opening stock is overvalued and opening stock I've added to the cost. So accordingly, my cost has shot up and my profit has come down. My profit has come down. Yes. This is how you have to analyze. Sir, all these dialogues or sentences I will try to mug up, sir. How many sentences will you mug up? Yeah. Options, guys. Marginal costing is higher than that of absorption costing. Profit. Yeah. So they're asking about profit. This seems to be correct, but let us check. Marginal costing is lower than the absorption costing? No. Marginal costing is equal than that of absorption costing? No, none of the above. So the answer is A. The answer is A, guys. Is that it? Yeah. We'll move forward. Question number 6. The main difference between marginal costing and absorption costing is regarding the treatment of, just now we have discussed, because of what? Fixed overhead. Because of fixed overhead, guys. That to be very clear, fixed manufacturing overhead, guys. Yes. Under profit volume ratio, the term profit means the sale proceeds in excess of total cost? No. Means the same thing as is generally understood? No. Is a misnomer. It in fact refers to what? Contribution. That is sales revenue minus variable cost. Is it correct? Yes, I had mentioned about it if you guys remember. The name is PV ratio, profit volume, but it is actually not profit percentage. It is contribution percentage. It is contribution percentage, guys. Yes, but still you also taught us the same, sir. Yes, that is how it is there in the books, academics. Now I cannot go beyond that and tell, hey, don't use PV ratio, use it as contribution volume ratio. Yeah, actually it is contribution ratio only, but when they ask PV ratio, what are you supposed to calculate? Same thing, guys. Chalo, the answer is C. Eighth one. Factors which can change the break-even point is, guys, before break-even point or else in break-even point, what all formulas you take? Fixed cost divided by PV ratio or contribution per unit. Correct. So what all will impact to this? What all will impact to this? Change in fixed cost will it affect? Yes, because numerator. Then change in variable cost, change in selling price will it affect? Yes, denominator. Denominator. That means all of the above. All of the above. If PV ratio is 40% of sales, then what about the remaining 60%? Variable cost. Variable cost. Okay, sir. Then the PV ratio of a product is 0.6. Profit is 9,000. Margin of safety. Divide each other. Divide each other, guys. Because contribution for margin of safety is equal to profit. So profit divided by PV ratio is equal to margin of safety. 9,000 divided by 0.6. 15,000. Answer is B. Fine, guys. We shall move towards practical problems. Totally 20 questions are there, but small questions, sir. Initially, small question. First one. If PV ratio is 60% and marginal cost of the product is 20, calculate the selling price. Guys, there itself it is there. Guys, PV ratio is 60%. That means how much is variable cost ratio? 40%. Amount is 20. So 20 divided by 40%. 50. Correct? Yes, sir. If you want, you can also check. 50 into, if you do 40%, which is nothing but marginal cost, you will get 20 rupees. Clear? So variable cost in rupees divided by variable cost in percentage. That's all. Okay, sir. Done. The ratio of variable cost to sales is 70%. PV ratio. Hello, PV ratio 30%. The break-even point occurs at 60%. Margin of safety 40%. Good. Of the capacity sales. Find the capacity sales when fixed costs are 90,000. Also compute profit at 75% of the capacity sales. Okay, find out capacity sales means 100%. Capacity sales here is nothing but 100%. Okay. Also compute profit at 75% of the capacity sales. Guys, MCQ question you assume. MCQ question, come on. Tuck. Sir, fixed cost is given. Can we calculate break-even sales? Yes. Guys, simple. PV ratio is 30%. Sir, how did you tell? Variable cost is 70. PV ratio is 30. So, 90,000 fixed cost divided by 30% will give you break-even sales in rupees. 3 lakh. This is how much percentage of sales? 60% divided by 60%. Break-even sales in rupees divided by break-even sales in percentage. Hello, amount please. 5 lakh. What is this? Sales. Total sales or capacity sales? Okay, sir. Then what else? Compute profit at 75% of the capacity sales. Now 5 lakh into 75%, assume this is the sales because this is capacity. Now let us assume my actual sales is 75% of this. 5 lakh into that. Then take contribution into 30% minus fixed cost. You will get profit. 1 second. Let me show somewhere. 5 lakh into 75%. 75 only, na? Yeah. How much? 375. So into 30% contribution. 1,12,500 minus fixed cost. See, this kind of question cannot be asked in MCQ. Tuck, 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 tuck calculation. If you are conceptually strong, tuck, 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 tuck calculation. That's all. 22,500. Okay, let me just look into the solution also once. Yeah. Variable cost or to sales is 70%. Contribution to sales would be 30%, which is nothing but PV ratio, guys. PV ratio. 1 second. Why is this? Yeah. PV ratio is 30%. We know that break-even sales into PV ratio is equal to fixed cost. Correct? Now interchange of position. Interchange of position, guys. Yes. So break-even sales into 30. This is nothing but PV ratio. Take it to the other side. Yeah, actually they would have straight away put break-even sales formula only. I don't know why they have interchanged the positions. Correct, huh? So straight away break-even sales into fixed cost divided by PV ratio. Break-even sales is equal to fixed cost divided by PV ratio. Why is this coin sound is coming? Huh? It is given that break-even occurs at 60% capacity. That means break-even sales in rupees divided by break-even sales in percentage, guys. Compute the profit of 75% capacity. So at 75%, what would be the sales? 375. Variable cost and all they have reduced. Straight away you can go and calculate contribution, guys. Okay, you can do this way also, nothing wrong. Then fixed cost you reduce, you will get profit. Profit. Okay, sir. Now coming to the third question, guys. You are required to determine profit when sales is 2 lakh, fixed cost is 40,000, break even point is 1 lakh 60,000. Okay. Also, determine sales when fixed cost is 20,000, profit is 10,000 and break even point is 40,000. Okay, so determine profit first thing, second thing is determine the sales, guys. Please be careful. Okay. Yeah. We know that break-even sales into PV ratio is equal to fixed cost, or else we know the regular calculation. Now, guys, do it. That is break-even sales is equal to fixed cost by PV ratio. Okay, sir. Now, break-even sales we know. PV ratio we don't know. Fixed cost do we know? Yes, sir. Can we calculate the PV ratio? Yes, divide each other. And if you multiply with 100, you will get percentage. You will get the percentage. Yes, sir. Next, we also know that sales into PV ratio is equal to contribution, which is equal to fixed cost plus profit. So sales into PV ratio will give us contribution minus fixed cost will give us profit. Minus fixed cost will give us profit. The format, that's all, guys. The format, that's okay. Again, break-even sales is equal to what, guys? Let me write actual formula. Break-even sales is equal to fixed cost divided by PV ratio. Break-even sales do I know? Yes. PV ratio do I know? No. So break-even sales 40 I will take. Fixed cost 20 divided by PV ratio. Now take PV to the other side and bring 40,000. So 20,000 divided by 40,000, 50%. 0.5 you will do get. So you can multiply with 100 also, you will get percentage. 50%. Okay, sir. We also know that sales into PV ratio, that is contribution, guys. Minus fixed cost will give you what? Profit. Yes, sir. So sales do we know? No. Now, do we know the fixed cost? Yes. Plus profit do we know? Yes, sir. Now, can you calculate contribution, guys? Can you calculate contribution? Yes. That is what, sir? Fixed cost plus profit is equal to contribution. How much is that? 30,000. 30,000. So contribution in rupees 30,000. Contribution in percentage 50%. How much is sales? 60,000. Better go with this. Okay. There might be little confusing if you do like that. Simple. Contribution in rupees divided by contribution in percentage, guys. Contribution in percentage. You will get sales. Okay, so fourth one. A company has made a profit of 50,000 during the year. If selling price and marginal cost of the product are 15 rupees and 12 rupees per unit. Guys, what is the contribution? Hello? 3 rupees respectively. Find out the amount of margin of safety. 3 rupees is the contribution. Company made a profit of 50. Guys, come on. Can we calculate PV ratio? 3 by 15. 3 by 15. 3 by 15 into 100. 20%. Do we know the profit? Yes. Guys, for margin of safety, what is the alternate formula? Actually, margin of safety means actual sales minus break-even sales. But we have one more formula. What is it? Profit divided by PV ratio. Profit is given 50,000 divided by PV ratio 20%. 2 lakh 50,000. Let us cross check, sir. Let us cross check, sir. You just told orally, sir. How can we trust, sir? Yes. So first you will calculate PV ratio, guys, which is 3 by 15. You will get 20%. Margin of safety, profit by PV ratio, which is equal to 2 lakh 50. Yeah. And guys, sir, will we get this kind of small question in descriptive? Chances are less. Might be they will ask multiple questions. Clear, like A, B, C, D. One of them might be this. If not, this kind of questions can come in MCQ. Sir, can they ask it just for 1 mark, 2 marks? They can ask MCQ. And you know, now MCQ can be asked for 2 marks also, not only 1 mark. Okay, few MCQs will be asked for 2 marks. Yes, sir. Yeah. And the thing is, MCQ doesn't have choice. Descriptive question has one choice, whereas MCQ doesn't have choice. Please be careful. That is why 100% syllabus coverage is very important. Some students try to be smart by skipping, sir, few topics. One choice will be there, no anta. What if question comes on MCQ? Correct. What if that question on that topic comes under compulsory under descriptive? It happens. This is the beauty of the CA course. You would have left one topic. Okay, now one topic, any chapter you assume. Now there are one question, one full descriptive question, 3 sub questions in that. 2 questions you know very well, A and B. C is on the topic which you are left. Now you are in the dilemma whether should you take that question or not. A and B you know very well, but C you don't know. Sir, now can I choose C from other question? Once you have taken one question, you have to answer all sub questions under that question. In that internal choice, you cannot make. You know Amir Khan, correct now? Let us call you from today, American Khan. Huh? Chala. Fifth one. If margin of safety is 2,40,000, silence. 40% of sales. Hey, silence. If margin of safety is 2,40,000, 40% of sales. That means what is total sales, guys? If I ask you, 2,40,000 divided by 40. Yes, that is 40%. Okay. And PV ratio is 30% of AB Limited. Calculate break-even sales and amount of profit on sales of rupees 9 lakh. Guys, tuck calculation. Okay, listen here. Margin of safety is 2,40,000. 40% of sales. So 2,40,000 divided by 40%. 6 lakh. Now, how much is break-even sales? 60%. Correct? Huh? So 6 lakh into 60%. 3,60,000. Got it? Huh? Yes, sir. Now coming to profit, they are asking. PV ratio is 30%, guys. So 6 lakh into 30%. What do you get? Contribution minus fixed cost. Do we know the fixed cost? No. But can we calculate? Yes. Break-even sales we will know. Apply break-even sales formula. Break-even sales is equal to fixed cost divided by PV ratio. We know break-even sales. We know PV ratio. Calculate fixed cost. Calculate fixed cost, guys. Yes. Let me just go through the solution. Fifth one, A first. Total sales is equal to, guys, simple. Sir, margin of safety in rupees divided by margin of safety in percentage. So you will get 6 lakh. Contribution into 30%, 180. Profit, margin of safety into PV ratio. Okay, into PV ratio, 72,000. 2,40,000 into 30%. Now contribution minus profit is equal to what? Fixed cost. They have done this way, that is also fine. Or else you can find it out through break-even sales formula also. You can find it out through break-even sales formula also, you will get same guys. No worries. Yes, sir. They have found out the profit and profit they have deducted from contribution. The balancing figure is fixed cost. You can do in that way also. Okay. Break-even sales would be how much? They have found out in another way, that is fixed cost divided by PV ratio. Or else simply, sir, total sales I already know. I know margin of safety is 40%. That means break-even sales is how much? 60%. So multiply with 60%. You will get same. Okay. Now coming to profit. And once you get break-even sales, through break-even sales formula, you can get fixed cost also. Profit. Sales into PV ratio guys. You will get contribution. Minus fixed cost will give you profit when sales is 9 lakh. When sales is 9 lakh. It's 1,62,000. Yes, sir. There is one more sub question there. X Limited has earned a contribution of 2 lakh and a net profit of 1,50,000 of sales of rupees 8 lakh. What is its margin of safety? Contribution to net profit 150 for a sales of 8 lakh. What is its margin of safety? Guys, can we calculate PV ratio? Yes, 2 by 8. 2 by 8, 25%. Profit we know. Profit divided by PV ratio. 1,50,000 divided by 25%. 6 lakh. So what is margin of safety? 6 lakh. Got it now? Margin of safety is 6 lakh. Okay, let us see. Let's go through the solution once. How they have done. First, they have calculated PV ratio 25%. Guys, if it is a descriptive, please show properly along with the formulas. Margin of safety is profit by PV ratio, which is equal to 6 lakh. Alternatively, they have shown one more way. Fixed cost is equal to contribution minus profit. We got 50,000. Break-even point. Fixed cost divided by PV ratio 2 lakh. Margin of safety is equal to balancing figure. Actual sales minus break-even sales. Actual sales minus break-even sales. This is another alternate way, but bit lengthy. I think this would be easy, but still, however, you guys are comfortable. See, especially in marginal costing, there will be at least two ways sometimes to calculate your answer. Whichever you are comfortable, whichever will strike to your mind first, go with that. Go with that, guys. Anyhow, you will get same answers only. You need not worry. Yeah. Sixth question. A company sells its product at 15 rupees per unit. In a period, if it produces and sells 8,000 units, it incurs a loss of 5 rupees per unit. If the volume is raised to 20,000 units, it earns a profit of 4 rupees per unit. Calculate break-even point both in terms of value as well as in units. Guys, same question I have already done it in the class, but I just want you to again to just discuss about it. We'll see. Okay, let me do it here. Period 1, period 2, I will take it. So period 1 sells its product at 15 rupees per unit. If it produces and sells 8,000 units. So 8,000 into 15 guys, quickly. 1 lakh 20. Tuck, 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 tuck. You give me the number. Then 20,000 into 15. 3 lakhs. So profit or loss? Profit or loss? First period. 5 into 5 into 8,000. Then second period 4 into 20,000. 80,000 profit. Correct? Any doubt? When things are like this, how do we calculate PV ratio? Change in profit divided by change in sales. Guys, change in profit. We have started from 0 now minus. In the second period, my start is minus. So from minus I have to go to plus, and from plus to from minus I have to go to 0 first, then plus. So totally what is the change in profit, guys? My 80 minus again minus 40,000. So minus minus will become plus. So 1,20,000 divided by 180. 1 lakh 80 into 100. 66.67 percentage, or for simplification you can take 2 by 3. Write what you have got and also show R 2 by 3 or 2 by 3. Okay, what they have asked? Break-even point both in terms of value as well as units. Guys, for break-even point we need one more thing. What is it? Fixed cost. Do they given? No. Take any one period. It is better to take with the profit period. Okay, so yes, sir. Now 3 lakh into 2 by 3. 3 lakh into 2 by 3. You will get contribution. 2 lakh. Contribution is 2 lakh minus profit. How much is that? 80,000. 1.2 lakh. What is that? Fixed cost. Even if you do period 1 also, you will get same. But please be careful. Loss you have to add. That is calculate contribution. How much? 1 lakh 20 into 2 by 3. Plus loss. Plus loss. Is that clear? Yes, sir. Now 1 lakh 20 divided by 2 by 3. How do you calculate in calculator? 1 lakh 20,000 divided by 2 into 3. 1 lakh, oh, 1 lakh 80,000. Break even sales, right? In rupees, 1.8 lakh. In units, divided by 15, 12,000. Or else you can also divide it by contribution per unit. How do you get contribution per unit? 15 into 2 by 3. 5 rupees. So break even sales, fixed cost divided by 5 rupees. Clear as same thing you will get 20,000. Hope you understood. Same question I had discussed in the class, guys. Because this is tricky question, I just wanted to discuss again. It's okay. Now see how they have discussed on that. Sixth one, you have already done. Let us go to the solution. See, I will just show. I will not discuss this because I will get a headache. Okay, if you can understand, you can follow this also. Okay, yes, obviously it is correct only, nothing wrong, guys. Bit lengthy is what I felt. Okay, X, Y, yo, sir, why all that? So X and Y sometimes we have to use. Okay, but here I think it was not required, but still they have used that method, guys. If you feel comfortable, you can follow the same. But answers try to match. Oh, let us go. Next question. Question number 7. You are given the following data, 2 years data again, guys. Sales profit, sales profit. Find out PV ratio, change in profit divided by change in sales. Break even point, profit when sales are 180. Sales required to earn a profit of 12,000, that is required sales. Margin of safety in the year 22-23. Yes, sir. Let us do it. 7. Yeah. Change in sales and change in profit, they have calculated here itself. So PV ratio, change in profit divided by change in sales into 100. That will give us 25%. Next, contribution in 21-22 would be 1,20,000 into 25%. Minus profit, you will get what? Fixed cost. Sir, why only 21-22? Can I take the next year also? Same. You will get same. Fixed cost is assumed to be same, guys, year after year. So now contribution is equal to what? Fixed cost plus profit. So fixed cost is equal to contribution minus profit. Means they have explained the equation. That's all. Whatever they have done here, they have just explained it here, guys. Fine, sir. We already know it. Break even point now. Fixed cost divided by PV ratio, which is equal to 88,000. Next, third one. Profit when sales are 1,80,000. Again, calculate the contribution first, straight away. You can straight away start with contribution. 1,80,000 into PV ratio, 45,000. Minus fixed cost, which will remain fixed, is equal to profit tax. Okay, sales to earn a profit of 12,000. What is the formula here? Required sales. Required sales in rupees is equal to fixed cost plus desired profit divided by PV ratio. So 22,000 fixed cost plus they want to make a profit of 12,000 divided by PV ratio 25%. That is equal to 1,36,000. 1,36,000. Just the margin of safety. Margin of safety 22, 23. Margin of safety is equal to actual sales minus break even sales. We know already both guys. Deduct each other, you will get 52,000. 52,000. Just so. Let us move to question number 8, guys. The product mix of Gamma Limited is as under: units 54,000, 18,000, selling price 7.5, 15, variable cost 6 and 4.5. Guys, here itself you can calculate contribution per unit 1.5 and 10.5. 1.5 and 10.5. Okay, sir. Find the break-even points in units if the company discontinues product M. Okay, product M they are discontinuing and replace with product O. The quantity of product O is 9,000 units and its selling price and variable cost respectively is 8 and 9. Contribution is 9. Fixed cost is 15,000. Fixed cost is overall, guys. Please be careful. Overall, not for any one product. Common. Common fixed cost. Yes, this question is on what? Product mix. What they have asked is find out break-even point. So break-even point, should we first calculate total? Yes. Then you break even between, or you break it or split it between the products. Yes, for which we should also calculate composite contribution per unit, guys. Yes. N and O. Sales is 18,000 and 9,000. That means, can we simplify it to 2 is to 1? Yes, sir. Or can I keep it as 18 is to 9 also, sir? Yes. 1, T, 2, T and all they have done. Okay. Let me explain in our style. Okay. So what is the contribution for N, guys? 10.5. O 9. Now let me calculate composite contribution per unit. Composite contribution per unit. 10.5 into weight of that 2 by 3 plus 9 into 1 by 3. Amount please. Sorry. How much? 10.5 into 2 by 3. Use simplex. Tak, 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 tak. Into 9 by 9 into 1 by 3. Composite contribution per unit is 10. Guys, what is the total fixed cost? Fixed cost divided by contribution per unit. You will get break-even sales. Overall break-even sales. Huh? 15,000 divided by 10. 1,000. Fixed cost is 15 only, na? Hello, last line it is given. 15,000 divided by 1,500. Sorry, divided by 10 will give us 1,500. 1,500. Now split it between N and O. Split it between N and O, guys. I will write it here. N, silence. N 1,500 into 2 by 3. O 1,500 into 1 by 3. So it is 1,000 units for N and 500 units for this 1 by 3. 1 by 3. Yes, 1 by 3. 500 units. So total comes to 1,500. 1,500. Did you guys get it? Yes. Yeah. And here they have taken 2T, 1T and all. The 2T and 1T is nothing but the ratio, guys. That's all. Clear? Yes. This is how we have learned. Same way you do, you get the same. Sir, what if they have asked in rupees? Multiply with selling price. Whatever units you have got, multiply with selling price. 1,000 into selling price of N, 500 into selling price of O. If they have asked in rupees, guys. Okay, sir. Let us march ahead. Question number 9, guys. Mr. X has 2 lakh investment in his business firm. He wants a 15% return on his money. So 30,000 profit is expecting. From an analysis of recent cost figures, he finds that his variable cost of operating is 60% of sales. PV ratio. 40%. Is fixed cost are 80,000. Now, I don't know what they asked, but break-even sales can we calculate? Yes, sir. Break-even sales divided by PV ratio. Show computation to answer the following questions. What sales volume must be obtained to break even? That means they're asking break even sales. Yes. Guys, see, what is my understanding is when they ask volume, it is quantity. Value means in rupees. But sometimes the institute interchange. Even when they ask it is volume, it is we have to calculate value only. Clear? Here, sir, can we calculate in units, sir? No, not possible. Actually, not possible. So, what should you understand it as? Value only. Clear? Yes. Next, what sales volume must be obtained to get that 15% return on investment? Guys, come on. They're asking you desired profit question. So, desired profit is how much? 30,000. 2 lakh into 15%. Yes, sir. Fixed cost plus desired profit divided by PV ratio. Mr. X estimates that even if he closed the doors of his business, he would incur 25,000 as expenses per year. At what sales would he be better off by locking his business up? Like this is a question on shutdown. Should I shut down or continue? That also I will explain. Third point is unique here. Okay? Yes. Sure. Come to the solution. First two are anyway I have already explained, but let us go through. Yeah. PV ratio is 40% guys, straightforward. Okay, sir. Fixed cost is 80,000. So what is the break-even point? Fixed cost divided by PV ratio, which gives us 2 lakh. Next, second, required sales formula you have to apply. First, calculate profit. 15% on 2 lakh, 30,000. Fixed cost is 80,000. So what is the total contribution required? 1 lakh 10,000. Apply required sales formula. Fixed cost divided by desired profit divided, sorry, fixed cost plus desired profit divided by PV ratio. Yes, sir. 2,75,000. Now, this is important, guys. See, actually, nothing about shutdown and all they have explained in ICM material also. There are two topics which they have not explained in detail or anything in ICM material also. But here, the question is asked. I will explain it. Don't worry. One is shutdown point. The other one is indifference point. Indifference point. Indifference point also I will make you to write also few things. But now, shutdown point. The last point is on shutdown point. Sir, what is it? Let us see. Avoidable fixed cost if business is locked up is how much, guys? 55,000. Sir, how did we get it? Guys, what is the present fixed cost? 80. They clearly told even if doors are closed of the business, we will continue to incur how much? 25. So can I call it as unavoidable fixed cost? Yes, sir. 25,000. That means can 55 be avoided? Yes, if I shut down. That is the hint they are giving. Out of 80, only 25 I will continue to incur if I shut down. That means remaining 55 is savable. Avoidable? Yes, sir. Minimum sales required to meet this cost is how much, guys? 55,000 divided by 40%. It is nothing but avoidable fixed cost divided by PV ratio. How much, guys? 1,37,500. Means what is the meaning of it? Listen, listen. If the company decide to continue, minimum sales should be 137,500. 137,500. If their sales is less than 137,500, then they will be making more loss. They will be making more loss. Guys, please understand here. Listen, listen. Interesting. Sir, if I shut down also, there will be a loss. Yes, how much? 25,000. Because there is zero revenue. Expenses is 25. So what is my loss? 25,000. Now, if I operate, still loss will increase. If I operate and make sales more than 137,500, my loss will be less than 20. Loss will be there, but less than 120. Sir, you taught us something called as break-even point. No, sir, that is 2 lakh. There, no profit, no loss. No profit, no loss. Now we are not talking about it. Now I have a confusion. I am in a dilemma. Should I shut down my operation or should I continue? So that is what I am making here. Guys, please pay attention because interesting. All these are interesting. Even in ICM material, they have not discussed the concept of this. But because if by chance if like this question comes in the exam, students also should not be like, sir, out of syllabus. When questions is given somewhere, you can expect that kind of question. So be ready for it. Sir, if my business are closed down, zero revenue, but loss will be how much? 25. If I continue, my fixed cost would be how much? 80,000. In order to keep my loss less than 25, I should make minimum sales of how much? 137,500. If I continue and assume my sales is 1 lakh, my sales is 1 lakh. Assume. 1 lakh into PV ratio, 40%, 60,000. Correct? Ah? Yes, sir. Now, how much is my fixed cost? 80,000. 40% only, no? Sorry, 40,000. Okay. Now, how much is the loss? 40,000. If I shut down, how much is the loss? 25. Better shut down. If I continue 40,000, na? Understanding? Yes. Sir, let me take 120. My sales is 120. 1 lakh 20,000. Into 40%, 48,000 contribution. Correct? Ah? Yes, sir. Minus fixed cost, 80. 32,000. What is this? Loss. Better shut down. Why? If you shut down 25, if you continue 32, which is better? Shut down. Aram se relax at home. Okay. Yes. Hope you understood. Clear? Now let me take 150. So more than 137,500. Less than 2 lakh only. Hello, I have not reached break-even point. Let us assume in between that. Let me take 150. 150 into 40%. 60,000. Contribution. Correct? Minus fixed cost. 80. 20,000 loss only. Loss only. If I shut down, what is the loss? 25. Now, if I continue and make a sales of 150, what is the loss? 20. Okay. At least 5,000 you can save. At least 5,000 you can save. Got it? Huh? Understood now? Yes. Yes. Chalo. Hope you guys understood the meaning of this. So, in simple, guys, what do we understand from this is, sir, if my sales is less than 1,37,500, then better shut down. Temporarily, not permanent. Clear up? Yes. Maybe 2 months, 3 months, my sales is down. That is when you are thinking about it. Okay. So, what if my sales is more than 137,500? Any amount? Can I continue? Yes. Better continue. You might be making loss, but maybe comparatively lesser. Continue. Continue. Is that clear? Yes, guys. And how did we derive this? You understood, now? Guys, avoidable fixed cost divided by PV ratio. Avoidable fixed cost divided by PV ratio. Better take down about this in your notebook, guys. I will just dictate. It's good if it is there in your note. Take down quickly. Shall I take down? You can just give a small entity called shutdown or continue. Shutdown or continue. You can also give link to the ICM material, guys, so that you can study this question also along with this. Page number would be 14.66. The solution page number I am telling. Okay. ಆಮೇಲೆ ಅಲ್ಲೋ ಕ್ವಶನ್ ಹುಡುಕಿದ್ರೆ ಕಷ್ಟ 14.66. Okay, take. Shutdown point is equal to avoidable fixed cost divided by PV ratio. Avoidable fixed cost divided by PV ratio. Or alternate formula. Or avoidable fixed cost divided by contribution per unit. Divided by contribution per unit. Divided by contribution per unit, guys. Is that clear? If you use the second formula, what do you get? Units. Assume, guys, you get 3,000 units. What is the meaning of it? If your sales is less than 3,000 units, better shut down. If it is more than 3,000 units, continue. Like, yes. Below this is the minimum sales. This is the minimum sales required to continue the operations. To continue the operations. To continue the operations. Full stop. Next line you write. Point wise. First point. First point. If the sales are less than, if the sales are less than the above. The above means whatever you would have calculated. Okay. If the sales are less than the above, comma, then better to discontinue the operation for temporary period. Then better to discontinue the operation for temporary period in order to reduce the losses. In order to reduce the losses. In order to reduce the losses. Next, second point. If the sales are more than, if the sales are more than the above, the above. If the above in the sense whatever number you get guys by using the formula, okay? The above, comma, then better to continue with the operation. Better to continue with the operations. Full stop and write below the small note. Avoidable fixed cost means the cost which will not be incurred if operations are shut down. If the operations are shut down. If the operations are shut down. Guys, see, normally fixed cost is something which we will incur no matter what. But see, few things. For example, sir, 2 months I am shutting down my operations. I will vacate my factory. So rent can I save? Maybe yes. Correct. See, sometimes you will not be able to vacate also. Why, sir? Because if you vacate now, again after in the third month you will not get. You want to vacate for second month, same factory will not be able to get in the third month. Correct? Yes. So there also you have to make some decision making properly. So, but in this situation, can there be any avoidable fixed cost? Yes. If it is there, we will take it as numerator, guys. So, shall we proceed further? Yes. They have also given some conclusion type here. Let us see. Mr. X will be better off by locking his business up if the sales is less than 1,37,500. In simple, they are telling. In good terms, they are telling. Face में ಹೇಳಿದ್ರೆ ಬೇಜಾರಾಗುತ್ತಲ್ಲ. Okay. It will be better off by locking his business up if the sales is less than 1,37,500. Oh. Let us move to the next question, guys. Question number 10. A company had incurred a fixed expenditure of 4,50,000 with a sales of 15 lakh and earned a profit of 3 lakh. Guys, come on, what is the contribution? Tuck, tuck. 7 lakh 50,000. Calculate. What are you calculating so much? Profit plus fixed cost is equal to contribution. During the first half year. This is the point. First half, only for 6 months. In the second half, it suffered a loss of 1,50,000. Guys, please be careful. Even fixed expenses, what they have given, and also sales, what they have given, considered to be for first half year. And in the second half, they are suffering the loss. Okay. Calculate the profit volume ratio, break-even point, and margin of safety for the first half year. Okay, sir. Easy. I will do it. PV ratio, guys. You know contribution divided by sales. Yes, sir. Then break-even point. you know fixed cost, you know PV ratio, divide it. Next, margin of safety. Margin of safety, you know profit, you know PV ratio. Can you calculate margin of safety? Yes. Or else you know break even sales, you know total sales. Can you calculate margin of safety? Yes, sir. Next, expected sales volume for the second half year, assuming that selling price and fixed expenses remain unchanged during the second half year. Assuming the selling price and fixed expenses remain unchanged in the second half, but you are making loss. Okay, sir. And guys, they're asking volume. Can we calculate volume here, sir? Volume in the sense quantity? No. That means what they are trying to ask, value. Then the break-even point and margin of safety for the whole year. For the whole year, guys. Chalo, come to the solution. Yes. In the first half year, contribution is equal to fixed cost plus profit, which is 7 lakh 50, guys. 7 lakh 50. Yes, sir. Next, PV ratio, contribution by sales into 100, which comes to 50%. Break even point, fixed cost divided by PV ratio, which is equal to 9 lakh. Then margin of safety, actual sales minus break even sales, which will give you 6 lakh. Or else you can also calculate it as profit divided by PV ratio. How much is profit? 3 lakh divided by 50%. You will get 6 lakh. You will get 6 lakh. In the second half year, contribution is equal to fixed cost minus loss. Please be careful because it is a loss. If it is a profit, you will add up. It is a loss. How much is the contribution? 3 lakh. Guys, one thing you can cross check here only. When there is a loss, contribution is more or fixed cost is more? Fixed cost is more. Clear? Just there only you compare it. Clear? So fixed cost is more. That is why when I do 3 lakh minus 4 lakh 50, minus is more. So we are getting negative. We are getting negative. How much is that, sir? 3 lakh contribution. Then expected sales volume, fixed cost minus loss, 3 lakh. That is divided by PV ratio. That is nothing but contribution. Okay, they would have straight away. Anyway, it is already calculated here. I don't know why they again showed it, but anyway, contribution divided by 50%. Expected sales volume is, guys, required sales is there. Na? We used to do what? Fixed cost plus desired profit. Papa, they are desiring to make loss here. Clear? So what should you do? Minus loss. Minus loss. So which we already done 3 lakh, you can straight away take it. 3 lakh divided by 50%. So that means how much will be their sales when the loss is 150? 6 lakh. 6 lakhs. Guys, see they have given some hint. Selling price and fixed cost will remain same itself. Clear? Maybe they have made less sales. That is why they are suffering loss. Clear? So when selling price is same, even variable cost is considered to be same. PV ratio will be same. Yes, sir. Fixed cost is also considered to be same. Yes, they have given it clearly. That means only sales would have changed. Sales means not selling price, quantity. Because of that, sales value also would have come down. Now, for the whole year, guys, 4,50,000 is a fixed cost per half year into 2, 9 lakh divided by PV ratio. PV ratio don't do 50 into 2, 100% anta. What about variable cost? Correct. That will come. Not now in the exam hall. Fixed cost into 2. Why not PV ratio into 2 anta? Clear? Please be careful, guys. See, simple. Selling price per unit will be same throughout the year. Variable cost per unit will be the same throughout the year. Will PV ratio change? No. Even if you take total, amounts will not be same. Okay. Obviously, into number of units, into number of units. Will it vary in total? Yes. But proportion will be same. The gap between sales and variable cost, will it be same? Yes, sir. Okay. So PV will be same, 50%. So what is the break-even point for the entire year? 18 lakh. 18 lakh. That means in a year, in order to break even, you have to achieve a sales of how much? 18 lakh. Then what did you calculate here, sir? That is for first half. So can I straight away do this only into 2, sir? Yes. Yes, you can do it. Oh, margin of safety. Profit divided by PV ratio. Profit divided by PV ratio. Guys, interesting. What is the total profit of the year? First half how much? 3 lakh. Second half how much? 150 loss. So net of you do 150 for the year. 150 for the year divided by 50%. 3 lakh. Hope you understood. First half profit, second half loss. So net adjust. What is the total profit for the year you calculate? Which is only 150 divided by PV ratio. Hope you understood. Please be careful, guys. Okay, this is profit, this is loss. So we have inter-adjusted. Done with the 10 points. Question number 11. The following information is given by Star Limited. Margin of safety 187,500. Total cost 193,750. Margin of safety 3,750. Break-even sales 1,250. Hello, total sales 5,000. Tuck, 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 tuck. Things has to keep on striking. Required. Calculate profit, PV ratio, break-even sales in rupees, fixed cost. Almost everything is ready, guys. Come on, see. Units is there. Margin of safety in rupees also is given. Total cost is given. Yes, sir. Everything you have to just split and do it. Fine. Come to the solution. 10th is done. 11th. Margin of safety, guys. Margin of safety in percentage we are calculating. Sir, total is 5,000. Margin of safety units is how much? 3,750 into 100 units. What is the margin of safety percentage? 75. Guys, total sales can we calculate now? Yes. Margin of safety in rupees divided by margin of safety in percentage. You will get 2,50,000. 2,50,000. What is this? Total sales. Now, profit is equal to total sales minus total cost. How much is that? 56,250. 56,250. Can we calculate PV ratio now? Profit is there, margin of safety is there. Can we calculate PV ratio? Yes, sir. PV ratio. Guys, you know the profit formula, na? Profit is equal to margin of safety into PV ratio. Let us interchange the position. PV ratio is equal to profit by margin of safety into 100. So we know profit and margin of safety. So how much is PV ratio? 30%. 30%. And please be careful, guys. Total cost is given, not variable or fixed. Clear? Yes. Now, if PV ratio is 30%, how much is variable? 70%. Clear? Yes. So, break even sales. Total sales minus margin of safety. Okay, first, margin of safety in percentage, how much, guys? 75. That means break even sales in percentage will be how much? 25. Yeah. Yes, sir. So, do total sales into percentage. What do you get? Break even sales in percentage. Sorry, in rupees. In rupees. 62, 500. Alternatively, also you can do it. Huh. Alternatively, also you can do. Sir, PV ratio we know. Can we calculate fixed cost, sir? Yes. Clear. But obviously it will be little lengthy. Now, break-even sales formula is what? Fixed cost divided by PV ratio. Or else, total sales you have. Margin of safety you have. So, deduct each other. Deduct each other. For example, rupees is given, margin of safety. That means total sales minus margin of safety in rupees. You will get break-even sales. Is that clear? Yes, sir. Another alternate formula is fixed cost divided by PV ratio. Fixed cost we need to find out because only total is given. Only total is given. How can we calculate, sir? First calculate variable. Total cost is 193,750. Now, how much is my PV ratio? 30%. So how much is variable cost? 70%. So 70% into sales. How much? How much quickly? 175,000. 1,75,000. So 193. My 193 750 minus 175. Sorry? What is this? Fixed cost divided by PV ratio. Divided by PV ratio. Hello. Yes, that way also you can. Sir, can we find out selling price and do it, sir? Yes, because margin of safety is there in rupees as well as units. Can we find out selling price? Yes, margin of safety in rupees divided by margin of safety in units. All the different alternate ways are there. Now only, actually I explained three ways, I guess. Fourth way is telling. Can we do in that way, sir? Yes, sir. Okay, but this fixed cost and all is bit lengthy, guys. Okay, you have to first find out variable, then fixed and all lengthy. Avoid, but still I just wanted to tell what all the different ways are there. Next, okay, fixed cost anyway here. Have they asked the fixed cost? That means we have to do it, means. No, no, okay, better. You can first find out fixed cost and then come to break even sales. Yeah, sales minus, sorry, into PV ratio will give us contribution minus profit will be fixed cost. Clear? Or else, the other way is like however I have shown here. Like that also you can do. First calculate variable cost, reduce total cost minus variable cost, you will get a fixed cost, guys. Yes, done with 11th. Coming to 12. A single product company sells its product at 60 rupees per unit. In 21-22, the company operated at a margin of safety of 40%. Margin of safety is 40%. The fixed cost amounted to 3,60,000 and the variable cost ratio to sales was 80%. Oh, guys, what all is given? Very simple. Product is selling price at 60 in 21-22. That is maybe last year because they are asking something for next year. The company operated at a margin of safety 40%. Break even sales 60%. The fixed cost amounted to 360. Variable cost ratio to sales is 80%. PV ratio 20%. Works. In 22-23, it is estimated that the variable cost will go up by 10%. And the fixed cost will increase by 5%. Some changes. We had done one question on this, you remember, revised break-even sales and all similar to that. Find the selling price required to be fixed in 22-23 to earn the same PV ratio as in 21-22. Sir, how come same PV ratio? Variable cost is changing. Maybe they will adjust it in the selling price. Okay. Assuming the same selling price of 60. 1 second. Assuming the same selling price of 60 rupees per unit in 22-23. Find the same selling price 60. Find the number of units required to be produced and sold to earn a same profit as 21-22. Means desired profit. Whatever profit you have made in 21-22, they are trying to tell keep the same as desired profit. Okay. Profit earned in 21-22. First they are doing that. Total contribution would be how much, guys? 50,000 into 12. Okay. First, let us do the working. Okay. Yes. Selling price is 60. Variable cost is 80% of that, guys, which comes to 48. So what is the contribution per unit? 12. PV ratio 20%. Actually, percentage is given. I think you would have straight away gone with percentage. 80 is variable. PV ratio is how much, guys? 20%. Straight away you would have done that, but that's okay. Maybe somewhere contribution per unit also is required. You can do it. If you do percentage also, you can do it. How is it, sir? PV ratio, if you do 20% into 60, how much you will get? Contribution per unit. Fine. Number of units sold in 21-22, guys. Break even point, that is fixed cost, divided by contribution per unit, how much? 30,000 units. Margin of safety is 40%, whereas break even sales is 60%. Balancing figure. So, break even sales in units divided by break even sales in percentage. What do you get? Total sales. How many units are sold in 21-22? 50,000 units, guys. Okay, this is working. Let us come to this. Total contribution 50,000 units are sold. So into 12 rupees per unit, which comes to 6 lakh. Minus fixed cost is given in the question itself, 3 lakh 60. So how much is the profit? 2 lakh 40,000. Selling price to be fixed in 22-23 next year. Revised variable cost is how much, guys? It will go up by 10%. So 48 into 110% you can take, or 1.10, or else 48 plus 10%. 52.80. Revised fixed cost will go up by 5%. So into 1.05, or else into 105%, or else plus 5%. 3 lakh 78%. PV ratio same as 21-22 na, they told clearly 20%. That means variable cost is how much, guys? 80%. I know variable cost in rupees. I know variable cost in percentage. Now can I calculate selling price? Yes, sir. Per unit. So 52.80 variable cost per unit divided by percentage wise how much? 80%. So what would be the selling price, guys? 66. Number of units to be produced and sold in 22-23 to earn the same profit. Same profit means how much, sir? 240. Desired profit now. 2 lakh 40. Fixed cost in 22-23 how much? Revised we have calculated. 378. Don't take same. It will increase by 5%. Please be careful. Because in a hurry you may take. Profit is same. So fixed cost also same anta. 6 lakh 18,000 is the desired contribution. Numerator we got. Numerator we got. Guys, please be careful how many units they have told. That means denominator should be what? Contribution per unit. So contribution per unit would be 66 minus 52.80. Minus 52.80. Correct? So contribution per unit is 7.20. So number of units to be produced. Guys, it is nothing but required sales in units. Fixed cost plus desired profit divided by contribution per unit. 85,834 units. So company has to sell 85,834 units to earn the profit. Please be careful not to break even. To earn a profit of 2,40,000. Clear? Yes. Any confusion? Dushyant and Manjunath. Yeah. 12th one done. 13th. You are given the following data for the coming year for a factory. Budgeted output 8 lakh units. Fixed expenses 40 lakh. Variable expenses per unit 100. Selling price per unit 200. Hello. Contribution per unit 100. Draw a break-even chart showing the break-even point. First calculate break-even point and then show the chart. Okay. If price is reduced to 180, what will be the new break-even point? Contribution per unit would be 80. Correct? Huh? Will break-even point change? Yes, sir. Fixed expenses is given divided by contribution per unit. Sir, I want to calculate in rupees. Can I calculate? Yes. Into selling price you do. Or else calculate PV ratio. Can we calculate? Yes, sir. Contribution per unit divided by selling price per unit. You'll get into 100. You'll get PV ratio. Yes, sir. Yeah. First, contribution per unit is 100 guys. Break-even point is fixed cost divided by contribution per unit. How many units? 40,000 units. When selling price is reduced, new selling price is how much? 180. So contribution per unit is 80. So new break-even point, fixed cost will remain same only. 40 lakh divided by 80. How many units guys? 50,000. Sir, can we calculate in rupees? Yes, just multiply with selling price. That's all. Or else you can use alternate formula, fixed cost divided by PV ratio. In that case, first you have to calculate PV ratio. Okay, sir. Now see the break-even chart. Break-even chart. Guys, first draw the fixed cost. Okay, 40,000. 40,000. 40 lakh, right? Yeah. So everything is in lakhs. 40 lakhs. Okay, sir. Next, total cost line. We'll start from here. Total cost line. Okay, sir. Then sales, you start from zero, guys. First sales line is this. Sales line. So this is my angle of incidence. So this is what my break-even sales in units. And this would be break-even sales in rupees. Rupees. Okay, sir. Now there is another change. That also they have done. But they have drawn in through dotted lines. Dotted lines. Let me change the color. New sales line. Variable cost will remain same? Yes. The fixed cost will remain same? Yes. Only selling price will change. Only selling price will change. So sales will slightly come down, guys. Correct. So you can observe that slight changes. Drop. Yes, sir. So where is the intersection point here? Yes. So if we just extend to x and y axis, you will get break-even sales in units as well as in clear. Yes, sir. And if they have asked like this two things, should I draw it in one diagram only or can I do it in two diagrams? See, it is good to do two diagrams provided you have so much time. Clear. If you have, you can do it. If not, chances are less guys asking this kind of things. One asking, okay. Two things asking, okay. Presenting two things in the question or in the chart will be little tough time taking. But still, if by chance if they ask, try to fit in one diagram only. Clear. No, sir, it won't look good. I want to draw the second one. Great, do it. But obviously, it will take little extra time. If you are ready to afford it, you can go. Okay. Question number 14, guys. Question number 14. A company has three factories. Interesting question. Please be attentive. A company has three factories situated in north, east, and south, with its head office in Mumbai. The management has received the following summary report on the operations of each factory for a period. Rupees in is in thousands. Sales and profit is given, guys. North, east, south, individually they have given. Actual, over budgeted, under budgeted. Over or under budgeted. Profit also. Actual, over or under. If it is over, it is in positive. If it is under, it is in bracket. Clear? Sir, what did you get from this is, guys, simple. See, at the beginning of the year, they would have set a budget. At the end of the year, they get actual. There is a gap between budgeted and actual. That is nothing but over or under. Clear? Guys, they used to give two period data. Na? Last year data, this year data, we used to calculate change in profit divided by change in sales and all. Correct? Yes. Here, they have given the data at the beginning and at the end. Can we calculate change in profit, change in sales? Yes. Actually, already given change in sales, change in profit. Can we calculate PV ratio? Yes, sir. Guys, that under or over is nothing but change in sales and change in profit. Hope you guys are getting it. Yes, sir. Calculate for each factory and for the company as a whole for the period, the fixed cost and break even sales. Yes, answer 14. First, actual. If it is under budgeted, add it, guys. Sir, what if it is over budgeted? Deduct it. Clear? Yes, sir. So you will get budgeted. Sir, what if I start with budgeted, sir? Then you have to do reverse. Then you have to do the reverse, guys. For example, budgeted minus under will be actual. Will be actual, guys. Okay, sir. Fine. So this is addition. Please be careful. So budgeted is equal to 1100 plus 400. Profit is equal to 135 plus 180, which will be 350. Okay, sir. PV ratio, let us calculate. Difference in profit divided by difference in sales into 100 also you can do. How much is that, guys? 315 minus 135. 135. So how much is that? 180. Already given, sir, directly. Again, why to calculate minus and all? But still do it. Show if it is a descriptive question, at least show it. Divided by 400, which is nothing but under. Okay, sir. So how much is the PV ratio? 45%. Then coming to east. Same thing you do, guys. Here it is over budgeted. So what do you do? Deduct. Deduct. Okay, sir. So actual minus over budgeted will be budgeted. Yes, sir. What is the PV ratio? 90 by 150. 90 by 150. And here don't worry about minus plus sign and all. Okay. Just if it is over budgeted, deduct. You will get actual. Sorry, budgeted. Whereas if it is under, you do addition. Clear up. But if you interchange the position, sir, I will take first budgeted, then opposite signs. Opposite signs, guys. Then coming to south. Actual, both are under budgeted, so you will add it, you will get budgeted, guys. Budgeted. So PV ratio is equal to 100 divided by 200 into 100, 55%. 55%. Is that clear? Yes, sir. Hope you understood. It is nothing but change in profit divided by change in sales. Guys, normally they used to give two period data. Now they have done what? They have given opening value, closing value. Opening or closing is nothing but, hello, budgeted means opening. Actual means what? Closing. Because budget, when will you fix? At the end of the year. At the beginning. Actual, when will you get? at the end of the year. So year gap is there, na? Clear? Yes. Sure. Now coming to fixed cost calculation. Actual sales into PV ratio minus profit. Minus profit. Do we know the profit for each of the brands, sir? Yes. So actual sales into PV ratio we have calculated for everything. Clear? Minus fixed profit we know. Take any one guys. Better take actual sales. Clear? Actual sales into PV ratio will give you what? Actual contribution minus actual profit will give you what? Fixed cost. Will give you fixed cost. So what is the total fixed cost? 1,350. Individually you have 360, 660, 330. Guys, any doubt? Yes. Next, calculation of break-even sales in thousands. Okay, in thousands. Yes, three because this is also in thousands only. Yes. North, fixed cost divided by PV ratio, 800. East, 1100. South, 600. Overall, how much, guys? 2500. All three branches put together. They have asked that also. Overall, 2500. Yes. Total fixed cost, 1350. Total break-even sales, 2500. Individually also we are done, zone-wise. Fine now? Yes. Chalo. Question number 40. We'll just finish it, guys. Yeah. Question number 50. An automobile manufacturing company produces different models of cars. The budget in respect of model 007 for the month of March is as under. Budgeted output 40,000 units. Rupees in lakhs is given, guys. Net realization. Net realization means what? Sales. 2 lakh 10,000 lakhs. Rupees in lakhs, so already 2 lakh 10,000 into what? Lakh. Variable cost 79,200, labor 15,600, direct expenses 37,200, specific fixed cost 27, allocated fixed cost 33,750. Allocated means maybe you have incurred it as common. How much is apportioned to this model? 33,750. Total comes to how much? 60,750. Total variable cost is 132, whereas allocated fixed cost is 60,750 lakhs. Total cost is 1,92,750 lakhs. Profit 17,250 lakhs. Sales again given. Anyway, they are given in the top also repeated. Calculate. Profit with 10% increase in selling price with a 10% reduction in sales volume. Now, selling price will increase by 10%, whereas the volume will decrease by 10%. Volume to be achieved to maintain the original profit after 10% rise in material cost. Only material, not all variable. At the originally budgeted selling price. Whatever is the originally budgeted selling price, okay, how do we get it? Divide each. Please be careful. 40,000 units. So this is 2 lakh 10,000 lakhs. Please be careful. If you do simply 2 lakh 10,000 divided by 40,000, then what number you will get? That is different. So we'll move to the solution. Yes, budgeted selling price is how much, guys? 2 lakh 10,000 divided by 40,000 into 1 lakh you do. Whatever you get into 1 lakh. 5 lakh 25. Guys, don't keep as it is. They have shown actually in a wrong way. If you do only this, you will not get 525. 5 lakh 25 you will not get. It should be into 1 lakh. Or else here itself you convert 2 lakh 10,000 into 1 lakh, then divide it by 40. Better. Clear? Yes. 5 lakh 25,000 per unit, guys. Please be careful when you are dividing something, both should be for equivalent. Clear? Yes. Chalo. Budgeted variable cost. 1,32,000 divided by 40,000 into 1 lakh. 3 lakh 30,000 per unit. Or else you do 1,32,000 into 1 lakh divided by 40,000. They have mentioned it here in lakhs, but it's better to show it in numbers also. Okay, is what I feel. Fine. Increase selling price, guys. 525 is there now. They want to increase it by 10%. How much is that? 5,77,500. New volume would be what, guys? 40,000 minus 10%, 36,000. Guys, here you observe. They are told volume will decrease by 10%, not value. Volume here means what? Quantity. In some other question, volume was what? Value. Clear? Yes, this should not happen, but still, fine. New volume means, guys, quantity is reduced by 10%. Please be careful. Presently, it was 40,000. Now we are deducting it by 10%, which comes to new volume will be how much? 36,000 units, guys. Okay. Sales 36,000 units into new selling price 5,77,500. Variable cost would be how much, guys? 36,000 units into 3,30,000. 3,30,000. Where we have got this? And sir, where did you get this 132? Guys, all the variable cost total. Clear? All the variable cost total. Okay. 3,30,000 is per unit. So 36,000 into 3,30,000. Please be careful. Don't take the copy paste. When volume changes, variable cost changes. Clear? Yes. Or else you can do like this. Hello, hello. Listen. Sir, instead of calculating per unit separately, can I do straight away? 132 is for 40. How much for 36? You can do that well. Clear? Yes. Because it is directly proportional to sales, guys. Okay. Contribution you got. Fixed cost, there is no change. Copy paste. Whatever is given in the question, total fixed cost you take. You will get profit. Better you show this in the brackets. Cost. Okay. Profit 28,350. Now everything here also they are presented in lakhs. Sir, when it is in rupees, how can I convert it in lakhs, sir? Divide it by 1 lakh. Divide it by 1 lakh. Clear? Huh? Hope you understood. For example, 5,25,000 into 36,000. Right? Huh? Sorry, 5,25,000. Sorry, new selling price. 5,77,500 into 36,000. You will get it in rupees. Now I want to convert it into lakhs. How, sir? Divide it by 1 lakh. Divide it by 1 lakh. Yes. Next. Second option. Budgeted material cost is how much? 79,200. Only material I am taking, not full variable. Only material. Only material is changing. Divided by 40,000. How much is that, guys? 192. Sorry, 198 present. 1,98,000 per unit present. Okay. It will increase by 10%. So into 110%. Or just plus 10%. 2,17,800 per unit. Okay, sir. Labor cost, direct expenses also do per unit. You'll get 3993. So variable cost total per unit 3,49,800. Budgeted selling price per unit previous only they told as per the previous selling price how much? 525. That is before the change, guys. Before the change, whatever was there, 5,25. So what's the contribution per unit? 1,75,200, and all of this is in rupees, not in lakhs. All of this is in rupees, guys. So sales volume will be how much, guys? Fixed cost plus profit. How much profit they want to make? 17,250. What is that 17,250, sir? The present. Just a minute. I will go back to the question. You can see the present profit. I will just read that question. Volume to be achieved, that is the quantity. To maintain the original profit means what? 17,200. Clear? Yes, sir. Yeah. Yes. So desired profit is 17,250. Fixed cost 60,750. Divided by contribution per unit. Again they made it in lakhs. 1,75,200 divided by 1 lakh. Because these two they have taken in lakhs, no? So denominator also they have made it as lakhs. Is that clear? Yes. How many units has to be sold? 44,521 units are to be sold to maintain the original profit of 17,250 lakhs. Got it, guys? Here volume means what? Quantity. Quantity. They are asking the quantity. Sir, what if they ask rupees, sir? 44,521 into selling price 5,25,000. That would be in rupees, guys. Okay, let us move forward. Question number 16. An Indian soft drink company is planning to establish a subsidiary company in Bhutan to produce mineral water based on the estimated annual sales of 40,000 bottles of mineral water. Okay, estimated sales is like 40,000 bottles. Cost studies produce the following estimates for Bhutanese subsidiary. Total annual cost, present percent of total annual cost, which is a variable. Okay, means how much is variable they are telling. Remaining will be what? Fixed. Material 100% variable, 2,10,000. Labor 1,50,000, 80% variable. That means 20% is fixed. Fixed. Okay, let me write that also. Fixed 0, 20%, 40%, and 65%. Factory overhead 92,000, 60% is variable, so 40% is fixed. Administrative expenses 40,000 is the total. In that 35% is variable. That means fixed is 65. Okay, sir. The Bhutanese production will be sold by the manufacturer's representative, who will receive a commission of 8% of sale price variable. This is also variable cost. Okay, selling commission 8% on selling price. No portion of Indian office expenses is to be allocated to Bhutanese subsidiary. This is like just a disclosure, guys. You would have learned in accounts and all. Some head office expenses will be allocated to subsidiary and all, but nothing like that here. Nothing like that here. You're required to compute the sale price per bottle to enable the management to realize an estimated 10% profit on sale proceeds. Do we know the sale? No. Do we know the cost? You will not know the cost until you know the sales. Why? One element is missing. That is commission. Because commission is dependent on selling price. So that means we have to do some XY calculations. Clear? Yes. We have done similar takings, if you remember, service costing, taking. Similar to that. Conductor row was to get conductor and driver, I guess. The commission on the takings, like that. Yes. Chalo. Then what, sir? Calculate the break-even point in rupees, sales as also in number of bottles for Bhutanese subsidiary on the assumption that the selling price is 14 per bottle. Second calculation is easy. First also is easy. First, let us calculate the total cost except commission. Except commission. That is our first agenda. Clear, guys? When we have done similar kind of question, in exam you will not waste time thinking. Tuck. You will start answering. Variable cost, material 2,10,000, labor 150 into 80%. Only variable portion you have to take. Factory 92 into 60%. Administrative overhead 40,000 into 35%. America understood? Commission I don't know. Let us keep it like that only. You can write and keep it blank. Okay? Yes, sir. Fixed cost, labor 150 into fixed portion 20%. Factory overhead 92 into fixed portion 40%. Administrative overhead 40,000 into fixed portion 65%. Guys, total cost you will not have it. Clear? Here it is written, but you will not have it. What is it, sir? Guys, except this. I will just scratch it as of now. Okay. Except this, all others we will have. Clear? Total up except that. Except that you have to total up. Okay. Don't write it, but just do it. Four lakh 92. Okay, where they have done. Oh, so now 4,92,000 is the cost except commission. Except commission. Guys, let us assume the sales as X. Sales as X. How much is commission? 0.08x. 0.08x. Then how much is profit? 0.10x. Correct? Hello? Let us assume sales as X. They have also assumed it to be X. Okay, sir. Now, total cost plus profit is equal to sales. Yes. Now, total cost is 4,92,000 plus 0.0x. Okay. Plus profit is how much? 0.10x. Yes. Is equal to what? X. Sales. Total sales. Not selling price. Total sales. Now, 4,92,000 plus 0.18x is equal to x. Take 0.18x to the other side. So 4,92,000 is equal to 0.82x. That is 1x minus x is equal to 1x. So 1x 0.18 comes to the other side. So minus 0.18. So that will give you 0.82x. So now x is equal to 4,92,000 divided by 0.82. X is equal to 6 lakh. Now can I calculate commission? Yes, into 8%. Can I calculate profit? Yes, into 10%. Okay. Have they got 6 lakh? Yes, 6 lakh. 6 lakh. Okay, guys. Now calculate. 6 lakh into commission, 8%. 48,000. Let me remove this. Yes. Next, coming to total cost, can you calculate now? Yes, 540. Plus profit. Profit, you can do it as working note or else here only you can show. Okay, you would already written sales here. 6 lakh into 10%. 6 lakh into 10%. Clear? Balancing figure also you can. Okay, once you calculate total cost, okay, sir. One balancing figure and that thing, sir. Oh, fine. That is it. Yeah. Selling price per bottle can I calculate? 6 lakh divided by how many units? 40,000 bottles. 40,000 bottles. So per bottle how much guys? 15 rupees. 15 rupees. In working note where they have shown profit amount calculation they have not shown, but here they have given working note reference. There only X is there. Amount is not there. Correct? Have they shown? Only up to 6 lakh they have stopped. Into 10% is profit amount 60,000. That's fine. Chalo. Next, they have told something. What else? They want to decrease the selling price to 14, right? They want to reduce the selling price to 14. So, what is the total variable cost, guys? Material, labor, factory overhead, administrative overhead will be same. Copy, paste. Okay, copy, paste. Only commission will change. Why, sir? Commission is on sales. Sales will not be 6 lakh now. Clear? Yes. How many bottles? 40,000 bottles. Into 14 into 8. Into 8 comes to 44, 800. So 4 lakh 44,000. Variable cost. Variable cost. Okay, sir. Now, selling price per bottle 14. Variable cost per bottle, whatever we have got, divided by 40,000 bottles. There only you can calculate variable cost per unit also and then bring it here. 11.10. So what is the contribution per bottle? 2.90. Break-even sales in units is equal to fixed cost divided by contribution per bottle year. Per unit in the sense per bottle year. Yes, sir. Which will give you 32,000 bottles into selling price. Will give you break-even sales in rupees. 4,48,000. Or instead of using this formula, can I use our regular formula? Fixed cost divided by PV ratio? Yes. In that case, you have to calculate first PV ratio. 2.90 by 40 into 100. That would be the denominator. Decimal you will get. Okay. Better you use this only. Or if you are getting decimal, instead of putting percentage, you keep it as 2.90 by 40. Keep it like that. It's clear. In that case, how do you do, sir? Simple. Fixed cost is 92,800. 92,800 divided by 2.90 into 40. Into 40. You will get same. You will get same, guys. When percentage and all is in decimal, better keep the numbers only. Don't put it in percentage. Or else you will get some differences. Oh, done with this. 16th done. Yeah. Yeah. Question number 17. Right? XYZ Limited has a production capacity of 2 lakh units per year. Capacity. Normal capacity utilization is reckoned as 90%. That means how much they are producing? 180. Normal capacity ಎಷ್ಟು Nishan? 1,80,000. Standard variable production cost are 11 rupees per unit. The fixed cost are 3,60,000 per year. Variable selling cost are 3 rupees per unit. Fixed selling cost are 2,70,000 per year. The unit selling price is 20. Selling price there. In the year just ended on 31st March, the production was 160, less than normal also. Capacity is 2 lakh, normal capacity is 180, and actual is 160. Very good. And sales were 150. That means what is closing stock? 10,000. The closing inventory, oh no. They only given closing. That means opening is their balancing figure. The close, see, if this dialogue was not given, then I would have told closing stock is 10,000, but some other things are there. The closing inventory as on 31st March was 20,000 units. That means we need to find out opening stock. Will there be opening stock? Yes, sir. The actual variable production cost for the year was 35,000, higher than standard. Please be careful. Variable they are talking about, not fixed. For normally fixed under absorption costing, what do we get? Hello, for fixed manufacturing overhead, under absorption costing, we get something. What is it? Under absorption or over absorption. And here they are not talking about that. They are talking about variable production cost was 35,000 more than the standard basis. Okay. Calculate the profit for the year under absorption costing and marginal costing. Explain the difference in the profits. Explain the difference in the profits. Due to what? Opening stock and closing stock. Now only I am telling you. Due to the difference in values due of what? Opening stock and closing stock. Okay. Sure. Seventeen answer. Income statement under absorption costing. Any working notes they have done? Yes. Guys, how do we fix the predetermined overhead rate based on the capacity? Here we will fix a rate because they have given normal capacity. Use normal capacity. Because they would have considered what? Normal ideal time. Clear up? Yes, sir. So predetermined overhead rate now is fixed based on what? Normal capacity. 2 lakh into 90%, which comes to 1 lakh 80. So what is the fixed overhead, guys? 360 divided by 180. How much is the fixed manufacturing overhead per unit? 2 rupees. Hope you understood it. For absorption costing important. Opening stock is 10,000 units. How did you get it? 150 plus 20 minus 160. It is valued at 13%. You know the equation, na? I will just write it. Opening stock plus production minus closing stock is equal to sales. Now we have everything except opening stock. So what do you do? Bring production and closing stock to the other side. Sales minus production plus closing stock is equal to opening stock. We are getting how many units, sir? 10,000 units. It will be valued at how much? 13 rupees per unit. That is variable plus fixed both. Variable plus fixed both, guys. Okay. Listen. Sales. 1,50,000 units at 20 rupees. Keep it on top. Okay. Or else you can bring it at the end also. Production cost, guys. Variable. 1,60,000 units are produced. Please take produced units into 11 rupees per unit. Okay, sir. And there is also an increase. They told 35,000 more than standard. Clear? Means more than you expected. So 35,000 should be added? Yes. 1795. 1795. And fixed is how much, guys? For each and every unit I produce, how much I will observe? 2 rupees. How did I get it? Predetermined overhead rate. Expected fixed cost divided by how much? Normal capacity. Normal capacity, guys. 2 rupees. So what is the cost of production, guys? 21 lakh 15,000. Now interesting. Now interesting. Please pay attention. Opening stock. Guys, normally they have to give the value. Here they have not given it. I should value it at how much? I should value it at how much? 11 plus 2. Correct? Yes. Opening stock. Please listen here, guys. I would have valued opening stock at the beginning or at the end? At the beginning of the year. Actually, it is at the end of last year. They should have given that value. They have not given. That means now I should value at the beginning of the year or at the end of the year? Beginning of the year. Guys, please pay attention. Now at the beginning of the year, did I have any idea about this? No. That means I should take only 11 plus 2. That is 13. So 10,000 units should be valued at 13. Add it up. Then coming to closing stock. This is interesting. Please pay attention. What is my cost of production? 21 lakh 15,000. For producing how many units? 1 lakh 60,000. In that, how much is closing stock now? 20,000. So 21 lakh 15,000 current period cost of production divided by units produced into 20,000. Why is a simple logic being? We are following FIFO. First in, first out. Means what is produced is there in my closing stock. Sir, you may ask me, why not opening stock? Opening stock as soon as the year start, first thing I will sell is opening stock. Clear? Yes. Hope you understood. Clear. Now you may ask me, hello, please, this is an interesting point. Now you may ask me, sir, can I simply take straight away 20,000 into 13, sir? Yes, it would have been correct, provided it was not there. But here it is there. If you do into 13, you are wrong. Clear? Because you have to consider this also. Now, this I will get to know at the end of the year. When will you value the closing stock? At the end of the year. So, should I consider the effect of this also? Yes, I have to. Yes, I have to. How many units I have produced? 160. What is the cost of it? 21 lakh 15,000. Out of that, 20,000 is still lying with me. What is the value of it? So 2115 divided by 160 per unit into 20,000. Into 20,000. Guys, hope you understood. Important key thing here is this one. If it was not there, then closing stock I would have done into 13 simply. Ashte. That is also fine, or else cost of production divided by units produced into closing stock units. Yes. Chalo. Yeah. Now cost of goods sold. Cost of goods sold. Next, under absorption of the fixed production overhead. How much? 360 minus how much we have observed? 320. So there is under absorption of how much? 40. Under absorption means I have charged less cost or more cost or less cost. Now should I add it to the cost or deduct it from the cost? Add it to the cost. So add 40,000. So what is your total cost now? 20, 20, 625. Okay, sir. Non-manufacturing expenses. Variable selling cost. How many units I have sold? 150. Guys, come on. Now tell me this 20, 26, 25 or even 1980 is for how many units? 150. Please be careful. I have already adjusted opening and closing stock. Anything which comes after that, this figure is for how many units? 150. 150. Please be careful. Okay. So selling expenses also should be for units sold. 1 lakh 50 into 3. Then take fixed selling expenses. You will get total cost. So total cost, you have to deduct it from sales. You will get profit. No need to show contribution under absorption costing. No need to show it. Yes, sir. Fine. Now coming to marginal costing. Sales, same. 1 lakh 50,000 into 20. Variable production cost, only variable portion here. How much? 160 into 11 plus that increase 35,000. How much it is, sir? 1795. They have taken variable selling cost here. It should come later, guys. It should come later. That is a wrong treatment. Opening stock 10,000 into how much? 11 rupees. 11 rupees, guys. That is opening, because at the beginning of the year, guys, I will not know this. Please be careful. Actually, opening stock should be valued at last year cost, not given. So best thing I can do is valued at 11, which you know at the beginning of the year. Which you know at the beginning of the year. Then coming to closing stock, different pattern. What is the variable production cost? 1795. For how many units? 160. Now, how much for 20,000 units? Closing stock. Because closing stock is out of current period production. So you will get 2,24,375 deductible. You will get now what, guys? Variable cost of goods sold, or else variable cost Production cost of goods sold. Clear? Yes. Guys, this I don't know why they have taken here, but it has to come later. It has to come later, or else that amounts whatever we calculate, the name will be different. Clear? Anyway, contribution you will get same only, but positioning also should be right, guys. Okay. So you will get variable cost of goods sold. See, the name what they have used is wrong. Okay, variable cost of goods sold will not include this amount. Yeah, that should come after that. So this 450, add it at this point, guys. Add it at this point. Okay, please show the arrow mark. Next page ಅಲ್ಲಿ ಇದೆ. Okay, please show like this. And write add to cost of goods sold. Add to cost of goods sold. Okay. Next, contribution. Contribution. Can we calculate, sir? Yes, sales minus variable cost. Sales minus variable cost. Then fixed cost you take 630, deduct it, you will get profit. So here also you have to write contribution minus fixed cost. That is equal to profit. Yes. Guys, under both, almost all the figures would be same. Even fixed manufacturing overhead later you will take care. Correct? Huh? See here, what is the fixed manufacturing overhead? 3 lakhs 60. Here, how much did we consider? 320 here. 40 later. How much? 360. So, did it have any impact on my profit? No, sir. But what will have an impact on my profit? Opening stock and closing stock. Opening stock and closing stock will always be overvalued in absorption cost. Yes. Sure. They have done reconciliation. Reasons for differences in profit. It is just like a reconciliation. Like how we used to do costing profit and financial profit. Na? Same way. Absorption costing they have taken as a base. 2 lakh 59, 375. Now check. Opening stock, guys. Come on. One by one. Quickly. Tuck, 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 tuck. Opening stock under absorption is how much? 130. Under 110. 20 more. Opening stock we have added to the cost or deducted to the cost? Added. That means you have taken 20,000 extra in absorption. So because of that, profit has come down by 20,000. Now what should you do? Add it. Add it. Opening stock undervalued in marginal costing. Better you write like this because my starting point is absorption. Now you write opening stock overvalued in absorption cost. Okay, either way it is same only, but as the base is my absorption costing profit, you always think from that point of view. Opening stock overvalued in absorption costing 20,000. Now coming to closing stock. Now coming to closing stock. In absorption costing, how much, guys? 2,64,375. Whereas under 2,24,375. What is the difference? 40,000. Guys, now tell me. You will add closing stock to the cost or deduct it? Deduct it. That means you have deducted more under absorption costing. Because of it, your profit would have gone up. So what should you do now? Deduct. Deduct. So closing stock overvalued in absorption costing or undervalued in marginal costing. Better to write it from absorption costing point of view just because you have taken absorption costing as a base. Yeah. Profit as per marginal costing 2,39,375. Matching up. Hello? Come back to the questions. 17th done. 18th. Actually, 18th question is on indifference point. Guys, before this, I just want to brush up that concept. What is indifference point? Indifference point. Open your notebook also. I will make you to write quickly. Open your notebook. Notebook. You can just give a small edit. Indifference point. Indifference point. Let me tell in simple. What is this indifference point means? Sir, I have a choice A and B. I have a choice A and B. Now assume in between this I have got 10,000. Now, if 10,000 is my sales, I am indifferent between A and B. I can either go with A or either go with B. Both will give me same results. Sir, what if it is less than 10,000? What if it is less than more than 10,000? Then I have to choose any one there. Clear? Which one to choose? This indifference point will help you. Hope you understood. Means if your actual sales is exactly indifference point, then it will not make me any difference. Sir. I can either go with A or either go with B. Clear? Yes. Chalo. What is the formula to calculate it? Write it. Indifference point is equal to change in fixed cost divided by change in variable cost per unit. Change in fixed cost divided by change in variable cost per unit. Per unit. Okay. Now, I will discuss along with the illustration so that you will get more clarity. Illustration on indifference point. Guys, I have a confusion whether to produce product A or product B. Now, this will help me. This concept will help me. Take how much is fixed cost and variable cost per unit and find out the difference. Guys, what is the difference? Let me calculate here. Difference 5 lakh and 5 rupees. Correct. So, what is the formula to calculate? Change in fixed cost 5 lakh divided by 5 rupees divided by 5 rupees. How much you will get? 1 lakh units. 1 lakh units. Guys, what is the meaning of this? Please pay attention. Interesting. Guys, if your sales is less than 1 lakh units, okay, first, exactly 1 lakh units. Go with A or B. It will not make any difference. Go with either A or B. It will not make any difference. Next, if it is less than 1 lakh, less than 1 lakh. Sir, which one should I choose? The product with lower fixed cost and higher variable cost. Which one? Yeah. Yeah. Why, guys? Because I will be producing and selling less number of units. Less number of units. Even though variable cost per unit is more, that's okay. But fixed cost should in total is less. So that I can recover as early as possible. Hope you understood. Yes, sir. Next. So I can tell A. Next, if it is more than 1 lakh, what should I do, sir? Go with where the fixed cost is huge, more, and variable cost per unit is less. I will go with product. Product B. Reasons are simple. Guys, I will produce and sell more number of units here. So my total variable cost will be multiplied variable cost per unit into number of units. So try to go with the option which is with low variable cost. So that my total will be as low as possible. Whereas even if fixed cost is more, okay, because I am producing more number of units, it will help me to recover. You know, na, as you produce more and more number of units, fixed cost per unit will keep on decreasing. And variable cost per unit, I am trying to keep less. Why? Because I will produce more number of units. Okay, 1 lakh 50, 2 lakh, 3 lakh, like that. So into variable cost per unit will be less, so that my total also will drop down. Hope you are understanding. Clear? Let me repeat. If your activity or sales is less than 1 lakh, you have to choose which product? Product with lower total fixed cost and higher variable cost per unit. If your sales or activity is more than 1 lakh, then choose the product which has higher fixed cost but lower variable cost per unit. Did you guys get it? Yes. First, take down this. I will dictate that conclusion. Take down till this 1 lakh. Take down this. Formula you finished now? Hello? Take down quickly. Done? Take down below that, guys. When the sales or activity, when the sales or activity is less than 1 lakh units, is less than 1 lakh units, comma, choose a product, choose a product with, choose a product with, choose a product with higher total fixed cost, higher total fixed cost and lower, sorry. Choose a product with lower total fixed cost, sorry, lower total fixed cost and, and higher variable cost per unit, and higher variable cost per unit. That is product A. That is product A. That is as per this illustration. Product A, guys. So if your sales is less than 1 lakh, then which product to better produce? Product A. Next, if the sales or activity level is more than 1 lakh, if the sales or activity level is more than 1 lakh, comma, then choose a product, then choose a product with higher total fixed cost, choose a product with higher total fixed cost and lower variable cost per unit, and lower variable cost per unit. That is product, that is product B, that is product B. Next, you write last sentence also. If the sales or activity level is exactly equal to, if sales or activity level is exactly equal to 1 lakh units, if sales or activity level is exactly equal to 1 lakh units, comma, choose either of them, choose either of them, either of them means A or B, A or B, that will not make any difference, indifference, okay, I am indifferent between A and B. Oh, now come back to the question, guys. Now come back to the question. Question number 18. The following are the cost data for three alternate ways of processing the clerical work of cases brought before the LC code system. A, manual. B, semi-automatic. C, fully automatic. Monthly fixed expenses are given, guys. Occupancy, maintenance contract, equipment lease. Okay, let me just total up so that it would be easy for us. 15,000, 45,000, 1,25,000. Unit cost, variable cost per report. 40, 80, 20, labor 260, 20. Add up here also. 240, 140, 40. Calculate the cost in difference points. Interpret your results. Guys, whenever you are doing, you have to do between two. You cannot consider all three. For example, you have to do between A and B. Then B and C. A and C. Like that. Clear? Yes. If the present case load is 600 cases and it is expected to go up to 850 cases in near future, select the most appropriate on cost consideration. Okay. Guys, just remember this figure and give it to me there. Yes. Yeah. We have three options, guys. A and B, A and C, and B and C. Clear? You have to calculate indifference point only between two options, not all three. Oh, differential fixed cost, guys. 45 minus 15, 30 here. Correct? We already done there. Okay, find out the difference. That's all. Yes. So first, let us go one by one. A and B, guys. First, differential variable cost 100. So what is the indifference point? What is the indifference point? 30,000 divided by 100, which comes to 300. 300 cases, guys. Okay. Formula also is given here. Maybe a formula you can write it on the top also. Indifference point is equal to what? Because for everywhere it is the common thing. Okay, 300 cases here. 300 cases, guys. Okay, sir. Next. Next, calculate for A and C as well as B and C, guys. So that is 110 divided by 200, 550 cases between A and C. Whereas for B and C, it is 80,000 divided by 100. You will get 800 cases. Any doubt in this? Differential in fixed cost divided by differential in variable cost per case. Per case or per unit? Here it is per case. Got it? Yes. The analysis we will do it. Interpretation of results. Okay. Cases. First, let me start with 300. Whatever we have got here, no, that only you can take it as a base. 300 and 500. Highest to lowest. Upper level, lower level. Yes. Guys, if it is less than 300. Oh. If it is less than 300, let us choose between A and B. If it is less than 300, you will go with what tax? Which is having lower total fixed cost and higher variable cost. Among A and B, who is having lower fixed cost? Check one, that is enough. A and B, who is having lower fixed cost? Who is having lower fixed cost? A. Who is having higher variable cost? A. So, we will go with whom? A. Correct? Huh? Yes. Chalo. Next. More than 300 but up to 800. More than 300 up to 800. Let us decide like this. Guys, if it is more than 300 here, whom will I choose? A or B? Whichever is having lower total fixed cost, sorry, higher total fixed cost and lower variable cost per unit. Who? Huh? B. Oh, I will choose B. Next, less than 800. Let me go with this. B is there, na? Okay. Less than 800 is less than 800. More than 300, less than 800. Correct? Now, let me choose between B and C. If it is less than 800, between B and C, which one will I choose? Which is having, which is having less than 800, guys, between B and C, which is having higher variable cost per case and lower fixed cost, which is having between B and C you choose. C, na? Yes, sir. So between B and C, I went for C. So that means, hello, less than 800 only, na? First one, A and B. If it is, once again, more than 300 means, obviously we will go with B, guys. Because less than 300, we went with A. So more than 300 means B. Now between B and C, guys, when it is less than 800, we will choose which option? The option with lower fixed cost and higher variable cost per unit or per case. What is it? Which one? B or C? C only. Just a minute. No, that cannot be. C, please be careful. Just a minute. I will only go back. Better. Last option is between B and C, right? Yeah. Between B and C, who is having less than 800 means please be careful. Lower total fixed cost. Who is having? B. Who is having higher variable cost? B. Right. You told C and confused me only. It is B. Clear? Because we have to compare both. Okay. Yes. Compare both in the sense. See, when I compared A and B, I got B. I should compare with C also. Because there also less than 800 we have to see. So now which one will we choose? B. Which one will we choose? B, guys. Please be careful, don't get confused. Pause for a moment, guys. Higher, lower, and all. It might confuse you slightly, but just pause for a moment and see. Guys, it is like this. When you produce more and more, your variable cost will increase. So try to keep your variable cost per unit lower. Total, even if it is more, okay. Because when I produce more and more, fixed cost per unit will come down. So go with higher fixed cost and lower variable cost per unit. Now the last one, more than 800. More than 800. Straight away, when it was less than 800, I choose B. Now what? C. If you want, you can check also. Okay, when it is more than 800, we will choose the option with higher fixed cost and lower variable cost per unit. You decide between B and C. It would be C. It would be C, guys. Hope you understood. Hope you understood. Sir, in between that 550 is required? Huh? No, that is not required. Okay, that will take still more time. Take only the lower and higher limit and decide. Okay, yes. They have given some interpretation also. At activity level below the indifference point, the alternative with lower fixed cost and higher variable cost should be used. And higher variable cost per unit gas. Please be careful. And even to fixed cost is total. At activity level, above the indifference point, alternate with higher total fixed cost and lower variable cost per unit should be used. Should be used. Hope you understood. Logically remember, don't try to mug up that sentences. Clear up? Yes, you know guys, already the basics are strong with you. Variable cost per unit will always remain same. If you multiply that with number of units, as you produce and sell more number of units, total variable cost will go up. Whereas total fixed cost will remain same. As you produce and sell more number of units, fixed cost per unit will come down. Will come down, guys. Yes. Second, they ask something else. Present case load is 600. Therefore, alternate B is suitable. 600 will fall where, guys? In between 300 and 800. When it is in between 300 and 800, which option did we select? B. As the number of cases is expected to go up to 850, that is more than 800. Which one did I choose? C. Alternate C. That's all. Yes, sir. 19th one. 19, last two. 19th is very interesting. Mark it as double star. Huh? Double star, ಇಲ್ಲ triple star. Okay. XY Limited makes two products, X and Y. Guys, please be ultra attentive, pro attentive. Huh? XY Limited makes the product X and Y. Name of the product itself is company name. Huh? Whose respective fixed costs are F1 and F2. Good. You are given that the unit of contribution of Y is 1/5 less than unit contribution of X. How much they didn't told? They told what is the difference. And the total of F1 and F2 is 150. That the break-even point of X is 1800 units. For BP of X, F2 is not considered. And that 3000 units is indifference point between X and Y. X and Y make equal profits at 3000 unit volume. Equal profits. Okay, please be careful. X and Y will make same profit if the sales is how many units? 3000. Considering their respective fixed cost. There is no inventory build-up as whatever is produced is sold. No opening stock, no closing stock. Required. Find out the values of F1, F2. They have given story F1, no F2 and all. We have to find out the value of it. And unit contribution of X and Y. Yes, unit means contribution per unit. That's interesting question. Please be attentive, guys. If you miss out in between, then you will be lost. Sir, I am already lost. Chalo. Let Cx be the contribution per unit of product X. Therefore, contribution per unit of Y is how much, guys? 4/5 of that. 4/5 of that. They gave some 1/5 story, na? Yes. 1/5 if you remove, what is left? 4/5. So, Cy is equal to what? 4/5 of Cx. 4/5 of Cx, guys. Because it is 1/5 less. Clear, huh? Yes, sir. So, can I tell it as 80% of CX. Hello. Contribution per unit of product Y is how much? 80% of contribution of product X. Clear? Yes. So both I have converted for X, guys. Clear? Yes. CX for product X, for product Y, 0.8 CX. Got? Hello? Yes. Individually for product Y, what is cost? Fixed cost, F1. For product Y, F2. I told something, Isha. Pay attention. F1 plus F2, both put together, they are given 150. Individually, they are not given. Individually, we need to calculate. Okay, guys, please pay attention. F1, fixed cost. Contribution into contribution per unit is how much? CX. Correct? Yes. Into number of units, 1800. 1800. Number of units is 1800. Have they given, sir? Yes. Let us see that. I will just go back and come. Okay. 1800. They have given that in the question. Just a minute. Here. At break even point. X is how many units, guys? 1800. Guys, at break even point. Fixed cost is equal to Gaganashti. At break even point. Fixed cost is equal to 0. No? Contribution. Fixed cost is equal to contribution. Profit will be 0. Profit will be 0. Correct, Mohan? Yes. Chalo. Please be careful. So, at break even point, if you want, you can write there. At break even point, contribution is equal to fixed cost. Contribution is equal to fixed cost, guys. So, fixed cost F1 is equal to contribution. What is contribution? How many units? 1800. What is the contribution per unit? CX. So, this will give you contribution. This will give you fixed cost. Both are equal. Both are equal. Okay, sir. F2 will be how much? Total we know na 150 minus F1 will give you what? F2. So we know F1 is 1800 CX. So F2 would be 1,50,000. That is total minus F1. Minus F1. This is nothing but total minus F1, guys. Total minus F1. Okay, sir. Next. Next. Indifference point, guys. Indifference point is at what? Guys, same profit is at how many units? 3000 units. They mentioned for product X and Y, they will have same profit at what point? 3000 units. So now at 3000 units, we know both the profits are equal. Okay, chalo, we will go with that now. Now for product X, guys, for product X, 3000 CX, that will give you contribution minus fixed cost will be what? Profit of product X. Profit of product X, correct? Contribution minus fixed cost of product X will be equal to profit of product X. Okay. This is nothing but profit of product X. That is equal to profit of product Y, guys. Now listen. What is the contribution of product Y? 3000 into what is the contribution per unit of product Y? 0.8 CX. Correct. You can take it as CY, but that is 4 by 5th of CX. So which is equal to 0.8 CX. Correct. So now what is the contribution of product Y per unit? 0.8 CX into 3000. So this would be the contribution for 3000 units minus F2. That will give you what? Profit of product Y. Profit of product Y, guys. So in simple, this is profit of product Y and this is profit of product X. At how many units? 3000 units. At 3000 units, guys. Okay, sir. Yes. Chalo. Now this you can also simplify. 3000 into 0.8 will come to how much? 2400 CX minus F. Minus F2 is fixed cost of product Y. Got it, no? Yes. Chalo, let us move forward. 3000 CX is equal to, now F1, F2 will bring. 1,50,000. Okay, or it's first this step I didn't consider. Oh, first let me finish this. 3,000 CX minus F1. Guys, F1 we have got here. 1,800 CX. So in place of F1, I am bringing that. 1,800 CX. Any confusion? Hope you understood. F1, I brought that value. 1,800 CX. Okay, sir. Then is equal to 2,400 CX minus F2 is equal to 1,50,000 minus 1,800 CX. I am bringing that, guys. In place of F2, I brought this. Clear? Because when F1, F2 both you don't know, you cannot keep it as F1 and F2 only. You have to change the values. Hope you understand. Yes, sir. Now, 3,000 CX. CX you all solve it now. 3,000 minus 1,800 plus 2 or else 1,50,000 is negative. Na? So let me bring that to the opposite side. It will become plus 1,50,000. Rest you take to the opposite side, guys. So it is like this. Let's 1 second. 1,50,000 on one side is equal to 2,400 plus 1,800 minus 3,000 plus 1,800. 3,000 CX. Hope you understood. I repeat. Guys, 150 as it is minus, I am taking it to the other side. It becomes plus. Bring CS part, everything to the other side. Now, let me highlight it in the blue color. 2,400 plus 1,800. Then minus 3,000 when it goes to the other side, minus. Then this when it goes to the other side, plus. So, plus 1,800. Clear? Which will give you 3,000 CX. So CX is equal to now 1,50,000 divided by 3,000, which is equal to 50 rupees, guys. 50 rupees. What is CX? Contribution per unit of product? Yes. How much is for Y? 0.8 of this. So for product Y it is now. Where they have done here. Contribution per unit of Y is equal to 0.8 of this or 4/5 of this, which comes to 40 rupees. Then coming to F1. F1 we have it here 1,800 CX. So 1,800 into 50, 90,000. 1,50,000 minus 90. 1,50,000 minus 90. That is our F2. 60,000. 60,000. So F1, F2, contribution per unit of product X as well as Y we have done. Y we have done. Guys, the challenging part here is you are putting these values. Solving it is okay, but framing the equation is the challenging thing. So please be careful if you don't know that concepts. For example, at the break-even point, my contribution will be equal to fixed cost. Or at the indifference point, the profit among both the options will be same. Then it will be difficult for you to form the equation also. Clear? Yes. So try to solve this kind of question again, guys, independent, without looking into the solutions. All this kind of questions will improve your thinking level. Yeah, 20th. 20th question. Prisha Limited manufactures 3 different products and the following information has been collected from the books of accounts. Sales mix they have given, selling price, variable cost. Guys, sales mix is nothing but they used to give product mix, sales mix and all 3:2:1 and all. Same way here. 4:3.5:2.5. Atara. Clear? Yes, sir. But they have given it in percentage. That's all. Okay, sir. Variable cost 150, 200 and 120. Can we calculate contribution per unit here only? Yes, sir. 150, 280. Total fixed cost 18 lakh, total sales 60 lakh. The company has currently under discussion a proposal to discontinue the manufacture of product C and replace it with E when the following results are anticipated. Okay. When E comes, what happens? Sales mix 45, 30, 25. Selling price 300, 400, 300. Variable cost 150, 200, 150. So contribution 150, 200, 150. Total fixed cost would remain same. Sales 64 lakh. Calculate. Required. Calculate the total contribution to sales ratio. Contribution to sales ratio. Okay. Sales is nothing but sales mix is given as same thing. And present break-even sales at existing sales mix means as per the first table. As per the first table. Okay, sir. Second one. Calculate the total contribution to sales ratio and present break-even sales at proposed sales mix. That is as per the second table. This is the proposed. Mohan, who proposed to whom? Chalo, state whether the proposed sales mix is accepted or not. So compare the profit and decide. Clear? Or compare the contribution and decide. Oh, fine. Sure. Yes. First point. Calculation of contribution to sales ratio at existing sales mix. Selling price minus variable cost times contribution per unit. PV ratio is given. PV ratio is, sorry, we have to calculate. How, sir? Contribution divided by selling price into 100. Then multiply it with sales mix, guys. Sales mix. You will get what? Contribution per rupee of sales. That is PV ratio into sales mix. Clear? That is 50 into 40%, 50 into 35%, 40 into 25% you do, you will get it. Overall, how much, sir? 47.5%. 47.5%. Present total contribution will be how much, guys? Total sales we know into 47.5%. What is the total contribution? 28,50,000 minus fixed cost will give you present profit. Present profit. Present break-even sales overall. Overall is how much, guys? Present break-even sales. Fixed cost is how much? 18 lakh. Divided by PV ratio. Overall you have to take. We used to do something called as composite contribution calculation and similar to that. Clear? Yes. And here already percentage is given. Just multiply as 10. Multiply both, you will get and add up all. Which is like weighted average. Which is like weighted average, guys. Okay. Then coming to proposed. Same calculation, numbers will change. Selling price minus variable cost. You will calculate contribution per unit. Then PV ratio. Better show it how you derive. For example, A. This is B. This is B. So, A by B into 100. 50, 50, 50. Sales mix. Multiply. Okay. Both you multiply. You get contribution per rupee of sales. 50% is overall. Overall. So proposed total contribution, total sales into 50%, which comes to 32 lakh. Minus fixed cost, 18 lakh. Will be proposed profit, 14 lakh. Proposed break-even sales is equal to 18 lakh divided, that is fixed cost overall, divided by overall PV ratio. Overall PV ratio, overall contribution ratio, guys, which is 36 lakh. 36 lakhs. Oh. Now, where is it better? Proposed profit 14 lakh. Oh. Present is 1040. Which is better? Proposed. The proposed sales mix increases the total contribution to sales ratio from. Okay, you can explain from that point of view also. Here, how much it was? 47.5%. Here it is how much? 50%. You can also explain in amount term. Here it is 2850 contribution. Whereas here how much? 32 lakh. Yeah. Let me read that. The proposed sales mix increases the total contribution to sales ratio from 47.5% to 50% overall, and the total profit from 10 lakh 50,000 to 14 lakh. Thus, the proposed sales mix should be accepted. Should be accepted, guys. Yes, sir. Done with practical problems. One last question, guys. Case scenario. Case. Let us solve the case. A meeting of heads of Department of Arnav Limited has been called to review the operating performance of the company in the last financial year. The head of the production department apprised that during the last year the company could operate only at 70% capacity level, but in the coming financial year they can operate at 95% capacity level can be achieved if an additional amount of 100 crore on capex and working capital is in. Okay, if they can incur extra 100 crore as capital expenditure and working capital, they can increase the capacity to 95% itself. Oh. The head of finance department has presented that during the last financial year, the company had a PV ratio of 40%, margin of safety and break-even sales were 50 crore and 200 crore respectively. Total sales 250 crore. Correct? Yes. To the reply to the proposal of increasing the production capacity level to 95%, the head of finance department has informed that this could be achieved if selling price and variable cost are reduced by 8% and 5% of sales respectively. Both has to be reduced. Fixed cost will also increase by 20 crore due to increased depreciation on additional assets. So you are introducing some additional assets now. Because of that, depreciation is increasing. Because of which fixed cost will increase. Okay, non-fixed cash only. Let us see anything related to that have they asked. The additional capital will be arranged at a cost of 15% per annum from a bank. That means this 100 crore investment is coming from where? Bank. What is the cost of that? 15%. 15 crore. 15 crore, guys. Guys, when they are given 15% per annum, is it a fixed cost or variable cost? Fixed cost. Cost of debt will always be fixed. Clear? And here they have clearly given 15% per annum fixed rate. That means it is a part of my fixed cost. Okay. In the coming financial year, it has been aimed to achieve an additional profit of 10 crore. They want to earn more profit of 10 crore. Whatever is the present profit plus 10 crore. Over and above the last year's profit after adjusting the interest cost on additional capital. Obviously, you have to claim that as an expense of 15 crore increase in cost. Okay. The following points is required to be calculated on urgent basis. To put the same in the meeting. You being an assistant to the head of finance has been asked the following. What will be the revised sales for the coming financial year? What will be the revised break-even point for the coming financial year? What will be the revised margin of safety for the coming financial year? Everything revised. The profit of last year and for the coming year. The total cost of the last year and for the coming year. Okay, these two I can do it together. Last two. Profit along with cost. Obviously, profit you will get only when you know the cost. Shall come to the last solution. Working note straight away I will go. Total sales is what, guys? Break-even sales plus margin of safety, which is 250 crore. 200 plus 50, both are they have given. There only I told. Total is 250. PV ratio is 40%. Variable cost would be how much? 60%. Remaining, correct, Naima? Remaining 60%. How much is my variable cost now? 250 crores into variable cost percentage. 150 crores. Okay, so fixed cost would be break-even sales into PV ratio, which is 80 crores. They'll just use break-even sales formula, which is fixed cost divided by PV ratio. They'll just interchange the position. How much is the fixed cost? 80 crore. Present or proposed? Present. Total cost now how much? 230 crore. Present. How much is the profit? Total sales minus total cost 20 crore. And now they want to add 10 crore for this and make 30 crores. Got it, no? Yes, sir. Chalo, revised, guys. Coming to all till now, whatever we discussed was present. Now revised. Present fixed cost 80. Increase in fixed cost they have given in the bottom. How much? 20 crore. Plus interest 15 crore. 15. So total revised cost is how much? 115. Sir, the 20 what was given is including 15, huh? No. Please be careful. Let me go back 1 second, because that confusion also might come. Let me read that sentence. Important. Guys, listen. Fixed cost will also increase by 20 crore due to increased depreciation. That means maybe 20% depreciation. Correct? Yes. Please be careful. That is not on additional assets. And this 15% is what? Interest on the capital. So 20 crore is different, 15 crore is different. Don't assume 15 is a part of 20 anta. Clear? Yes. So 20 plus 15, both we have to take as. Yes. Silence. Revised fixed cost is 115. Assuming that the present selling price is 100. Revised selling price will be how much, guys? 92. Variable cost would be how much? reduced from 60 to 55%. It will come down by 5%, right? Presently it was how much? 60%. We have found out somewhere here. Yeah, 60%. It will come down by 5%. So how much is that? 55%. Of how much? 92. So it is 50.60. Contribution is 92 minus 50.60, which is 41.40. New PV ratio 45%. Yeah, sales I have assumed it to be 100, which was the past. Now it will get reduced by 8%, so 92. Whereas the variable cost, guys, we have taken it as overall. So from 60, it has come down 5%. Means for how much, sir? 55%. 55%, guys. Just so. Chalo. Now we will go and answer. Revised sale. Revised fixed cost plus expected profit will give you what, guys? Total contribution. Correct. So revised fixed cost is how much? 150. How much profit they want to make? Present 20 plus additional 10. The desired profit is 30 crore. 30 crore. Divided by PV ratio, we just now discussed. What is it? 45%. New, proposed. Yes, sir. What it will give us? Required sales. Required sales to make how much profit? 30 crore. Yes, sir. Revised break-even point, guys. Fixed cost divided by PV ratio. Fixed cost here only we have taken a simple. 115 crore divided by 45%. Revised margin of safety. Total sales minus break-even sales. Total sales minus break-even sales, guys. That is 322.22 minus 255.56. Then fourth one. What is that? Present profit and future profit. We already done. 20 and 30. Yes, sir. Cost. In last year it was 230 crore. Proposed. Total cost in the coming year. Variable plus fixed. Revised sales into 55% is variable. Yes, sir. So it comes to how much? They are not shown it. Sorry? 2. Sorry, 2. 100 something will get. 177.22 plus fixed cost 115 plus fixed cost 115, guys. 299.22. 299.22. Or else you can do like this also. What is your total sales minus profit? 322.22 minus total profit 30. 30. Are you getting sale? 292.2. That's all, guys. This is all about the questions from ICI material on marginal cost.